Welcome to The Explainer. Today we're going to talk about unlocking a powerful financial tool, one you might not even realize you have. It's sitting right under your feet, your home's equity. So let's start with a really common scenario, right? You've got a big financial goal. Maybe you're dreaming of that new kitchen, or you really need to get a handle on some debt. But how do you fund it without getting stuck with those crazy high-interest loans? Well, the answer might be right there in the value you've already built up in your own home. So here's what we're going to cover. First, we'll break down what home equity actually is. Then, we'll dive into the three main ways you can tap into it. We'll help you figure out which tool is the best fit for your goals. And to wrap it all up, we'll answer some of the biggest questions that pop up. Okay, first things first, let's get right to the heart of this and really understand what we're talking about. This hidden value in your home. So what is home equity anyway? This is so important to get. Home equity is the piece of your home that you actually, truly own. It's not just some number on a piece of paper. Nope. It's a real asset. And it grows in two ways. Every time you make a mortgage payment and whenever your home's value goes up. Let's make this super tangible with a quick example. Imagine your house is valued at, say, $400,000, and you still owe $150,000 on the mortgage. Well, you just subtract that mortgage balance from the value, and boom, that's $250,000 in home equity. It's that simple. You can use that exact same formula to figure out your own. All right, so now that we've got a handle on what equity is, how do you actually use it? Let's talk about our first tool, the home equity loan. This one's the classic, the most straightforward option of the bunch. Think of it pretty much as a second mortgage. You get a lump sum of cash all at once, and then you pay it back over a set amount of time. The big advantage here? Predictability. You know exactly what your payment is going to be every single month, which is perfect for those big one-time expenses where you know the total cost right from the start. Okay, next up, we've got a much more flexible option. It's called a home equity line of credit, but you'll almost always hear it called a HELOC. And yeah, this one works in a completely different way. Honestly, the easiest way to wrap your head around a HELOC is to think of it like a credit card. It gives you a line of credit that you can borrow from, pay back, and borrow from again whenever you need it. But, and this is the real game changer, because it's tied to your house, the interest rates are way, way lower than a typical credit card. We're talking a huge difference. So a HELOC usually comes in two stages. First, you've got the draw period. That's when you can take money out as you need it, kind of like writing a check or using a debit card. Then, that's followed by the repayment period. At that point, you can't borrow anymore, and you just focus on paying back the principal and interest. It's a great system. You get all that flexibility up front with a structured plan to pay it off later on. And that brings us to our third and final tool, which, again, works a little differently than the first two. Let's talk about the cash-out refinance. Now, the key thing to understand here is you're not adding a second loan. What you're actually doing is replacing your current mortgage with a brand new, bigger one. And the difference between your new loan amount and what you owed on the old one, that's the cash that lands right in your bank account. So when does this make the most sense? Well, it's a fantastic option if interest rates have dropped since you got your original mortgage. Or maybe your credit score has gotten a lot better. Because you could potentially lock in a lower interest rate on your entire mortgage and get cash out at the same time. I mean, that's a pretty powerful 1-2 punch for your finances. Okay, so we've got these three awesome tools on the table: a home equity loan, a HELOC, and a cash-out refi. The big question is, how do you know which one is right for you? Well, it all boils down to your goal. What are you actually trying to accomplish? All right, let's say you have one big specific expense. You need to pay off a huge medical bill, or you want to consolidate all your high-interest credit card debt into one payment. In that case, the home equity loan is probably your best bet. You get that lump sum of cash you need, and you get the peace of mind of a fixed, predictable payment. But what if your expenses are ongoing, like a big home renovation where you're paying contractors over several months, or you're starting a business and costs pop up unexpectedly? That's where the HELOC really shines. Its flexibility is perfect because you only borrow what you need when you need it, and you only pay interest on what you've actually used. It's super efficient. And then there's the cash-out refinance. This is the one to look at if the stars align, meaning if you can get a better interest rate than you have now on your main mortgage. If you can, it's like a financial 2-for-1 deal. You get the cash you need, and you improve the terms of your biggest loan. Pretty sweet. Okay, before we finish up, I want to quickly hit on two of the biggest, most important questions that people always ask when it comes to tapping into their home equity. First up, How much can I actually borrow? This is so crucial for your planning because here's the thing. Just because you have, say, $100,000 in equity doesn't mean you can borrow the whole $100,000. So what's the real number? Well, lenders generally want you to keep some skin in the game, right? They want you to have a cushion of equity left in your home. So typically, they'll let you borrow up to about 80 to 85% of your home's total value, and then they subtract what you still owe on your mortgage from that number. Okay, question number 2 is a biggie, especially because the tax laws have changed. Is the interest I paid tax deductible? This is super important to get right. The short answer is it depends. And it depends entirely on what you use the money for. Here's the rule of thumb. If you use the funds to buy, build, or substantially improve the home that's securing the loan, think a new roof or a big kitchen remodel, then yes, the interest is usually deductible. But if you use it to pay off credit cards or buy a car, then no, it's generally not. And that really gets to the heart of it all, doesn't it? This whole idea really sums up both the power and the huge responsibility of using your home equity. Look, it can be an absolutely incredible tool for achieving major life goals, but you have to be disciplined, and you can never forget that your house is on the line. It's the collateral. So, as we wrap this up, the real question isn't just about which loan is best. It's bigger than that. It's about what you want to build. What goal, what dream, what project could that hidden value in your home finally help you unlock?